Welcome to Dr. Fred Markets. This is not financial advice. While most people scroll past the noise, a few take the time to understand what's really going on. Finance, crypto, artificial intelligence, this is where it all connects. You made the right choice being here. Let's dive in.
Your stock portfolio is bailing out crypto, and you don't even know it. That diversified index? It's your piggy bank for the next crypto mania. Verdict: the US stock market is now the quiet collateral engine behind every serious crypto bet, and the numbers say you're already involved whether you touch a wallet or not. Signal 1, S&P 500 today, 737.62, up 0.83%. That looks like a sleepy green day. But zoom out, under the hood, the S&P has turned into a leveraged tech and liquidity machine. Nvidia at 215.20, up 1.75%, is the mascot. You think you're buying the American economy. You're actually long a liquidity regime that keeps both stocks and crypto inflated. When the S&P drifts higher on light news and soft volume, it's not confidence. It's cheap collateral walking around in a suit. Here's the thing no one says. When your index creeps up like this, every hedge fund long crypto gets richer without Bitcoin moving a cent. They borrow against the stocks you hold. They post S&P futures, mega-cap tech, or baskets as collateral. Green stock day equals bigger collateral cushion, more room to lever into BTC, ETH, and the weird stuff they never tell clients they touch. Signal 2, crude proxy USO is red, 133.59, down 1.2%. Energy down while indexes grind up is not yay lower input costs. It's the opposite. It means the real economy is losing narrative power while financial assets keep partying. Oil soft, stocks up, Nvidia ripping? That's markets yelling, "We don't care about trucks and tankers, just give us more balance sheet power and bites." This matters for crypto because the correlation regime has changed. When oil drifts or bleeds and equities still push up, traders get a clear message. Central banks and big money prefer asset inflation to real-world pain. That's a green light for risk-on rotations. Crypto is the far edge of that risk spectrum. If energy was spiking and stocks were dumping, your crypto bag would be the first thing on the chopping block. Today, it's the opposite. Financial assets up, real-world commodity down. Risk stays on the table. Signal 3. Nvidia's 1.75% pop is not just about GPUs. It's liquidity theater. Every beaten-to-death AI and chip story hides one boring, brutal fact. These megacaps are collateral-quality gold. Big funds don't just own Nvidia for AI exposure. They own it because banks love it as margin. A volatile asset that trends up and trades like water is a collateral factory. Tie this to crypto. When Nvidia rips on a green S&P day, your broker and your prime dealer treat your book as safer. Safer book is more margin. More margin, more risk slots. And those risk slots don't get filled with treasury bills. They get filled with options, leverage, and crypto proxies. That's where your safe stock account becomes someone else's rocket fuel. Here's the cliffhanger. What happens when crypto pukes 20%, but the S&P and Nvidia stay green? The connection. In this new regime, it's no longer stocks or crypto. It's stocks for crypto. Your US equity exposure is the collateral stack that lets serious money lean into digital assets.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
That's the one thing almost no retail investor understands. Mechanism time. Step 1. Wealthy investor or fund loads up on high-quality US stocks and S&P exposure. That's you, your 401k, your sensible index position. Step 2. They go to a broker or prime desk. They post those stocks as collateral. The broker assigns a loan value, maybe 50 to 70% of that portfolio, sometimes more for liquid megacaps. Step 3. They use that borrowed cash or derivatives capacity to buy Bitcoin, Ethereum, or listed crypto products. Your precious index fund becomes their safety net. If crypto dumps, they don't blow up immediately because they can lean on your beloved Nvidia, S&P futures, and blue chips to keep the margin calls away. If stocks stay firm and crypto dumps, they survive. If both dump, they die. If both go up, they feast. Now look back at today's tape. S&P plus 0.83%, Nvidia 1.75%, USO 1.02%. Translation: collateral base rising, risk appetite healthy, real economy indicators soft. That is literally the textbook condition under which professionals extend risk into crypto while retail stares at CNBC and asks if Nvidia is overvalued. So here's what this means for you. If you only own US stocks, you're already playing crypto, just for smaller upside and without the education. If you only own crypto, you're ignoring the collateral backbone that will decide how long your bull markets last. If you own both, but treat them as separate universes, you're driving blind. This is not financial advice, but here is the truth. 1. Watch the S&P as your crypto collateral barometer. Green grind higher with no real macro news is not boring. It's crypto-friendly fuel. When indexes melt up quietly, assume more leverage is creeping into digital assets. 2. Treat Nvidia and the megacaps as a proxy for how generous that leverage will be. If Nvidia bleeds while S&P holds flat, that's collateral quality decaying. Less margin, tighter risk limits, less aggression in crypto. When megatech rips, margin clerks relax. Your altcoins get a longer leash. 3. Build your own mini version of this system. If you're going to hold US stocks anyway, decide intentionally whether they're just retirement wallpaper or your personal collateral pool to lean into a small, controlled crypto slice. Size it like an adult. Assume both can drop 50%. If that assumption makes you sweat, you're overextended. Your action: pick one crypto asset and one US equity benchmark, say Bitcoin and the S&P. For the next 30 days, log daily moves side by side with one note. Was today a collateral expansion day or contraction day? You will start to see the pattern. Stocks move first, collateral breathes, then crypto exhale or inhales later. You learn that. You stop trading headlines and start trading the plumbing, and the plumbing is where the money is. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.